and welcome to the PMI podcast. I'm Georgina Kensley, and I'm here today with Ralph McClelland from Sackers. We're going to be speaking to you today about buy-ins and buyouts, residual risks, and what to do about them. But before we start, Ralph, do you mind telling us a little bit about yourself and what you do at Sackers?
So I'm a partner at Sackers, and I have a specialism in risk transfer transactions. So probably from my perspective, some of the highlights have been working on some of the largest transactions in the market, including a 2.8 billion buy-in for the National Grid Pension Scheme. But I have a particular interest in the developing area of residual risks cover.
Okay, great. So I'd like to start off with asking you, what is risk transfer transaction?
So when we talk about risk transfer transactions in the context of UK occupational pension schemes, and to be clear, that's final salary schemes rather than the more popular now DC arrangements, we're talking about a transaction where the trustee and the company tries to reduce the risks associated with the funding the defined benefit promise of the pension scheme. And specifically, most people these days, when they start talking about risk transfer, are talking about either a buy-in or a buyout transaction with a UK insurer.
So you could tell us a little bit more about the difference between a buy-in and a buyout.
A buy-in is a transaction where you purchase an insurance policy with a UK insurer that secures some or all of the benefits associated with the members. So what you would typically do is you would go into the market, and there's perhaps between half a dozen and 10 major insurers offering annuity business in this space. And you would buy an insurance policy that echoes either a population of your membership, so that's pensioners and deferred members, or part of your pension and deferred membership, or all of your pensioner and deferred member benefits. And the idea would be that you would continue running on the pension scheme, but with an insurance policy, which is essentially an investment asset that matches the liabilities, or closely matches the liabilities associated with your pensioner and deferred member population. A buyout is where you have bought in all, or in most cases, all of your member benefits, and you then transfer the bulk annuity policy that you're holding as an asset of the scheme into individual members' names, so that the individual member then faces off against the insurer. They've got a policy that should fully match the benefit that they're entitled to under the scheme, and the trustee can then wind up and ride off into the sunset for a happy ending. So that's obviously the end game for a lot of pension schemes now in the UK.
And how do residual risks arise?
So residual risks arise, and it's a good question. Now this goes to the core of how a buy-in transaction works. So as a trustee, usually with the support of the sponsoring employer, you go to the market with a benefit specification that is based on your understanding of the member's legal entitlement. And then you hand over the data that you have been using to administer the scheme. So that's things like postcodes, final pensionable salaries, age, numbers of years service, whether or not there are spouses or other dependents. So that's all of the data that's interpreted by the benefit specification and goes to define a cash flow, essentially. And your buy-in policy, or in due course your buyout policy, the member's name, is defined by reference to that data and that benefit specification. Now, it is inherent in that there is a risk that either the data that you've handed over isn't quite correct, or the benefit specification that you've prepared doesn't reflect the member's legal entitlement. So things that could arise would be, for example, missing beneficiaries. Maybe when you defined the population of pensioner or deferred members, you didn't get everybody. Perhaps there's an error in the data. Perhaps you didn't get the right number of years service or the final salary amount, or perhaps you didn't get the number of years service correct. All of this could arise in practice, and if it does arise, you could find that what you have done is secured a benefit with the insurer that doesn't actually match what the member's entitled to. And if at that point the member comes out of the woodwork and says, hey, hang on, I'm a member of the scheme, or hey, I'm entitled to a higher benefit than what you've secured for me, they might have a claim against the trustee or the company, which you need to think about. Now, this all sounds a little bit kind of unlikely. Surely if a scheme has been running for decades, which many of these schemes have, I looked at a scheme the other day that was founded in 1942, how could these errors possibly arise? And the clue is to some extent in the question I've asked. These are schemes that have been running over many, many years. They very often involve complicated corporate history where one or more businesses have merged together and pension schemes have merged as a result of that. I know myself that I find it quite difficult to find my kind of bank or other personal records from a few months ago. Imagine the challenges involved when we're looking at decades and multiple different companies. You know, you're talking about dusty old storage box, microfiche, all the sort of stuff that happens in a society that's changed an awful lot in that time. So the risk of these errors are not to do with bad administration, they're to do with a very complicated and very long period of time.
Right, okay. So how significant are the residual risks?
This is a question we're always asked, and we always find it very difficult to answer because, to some extent, the big risks are the ones that you don't know about, and if you don't know about them, it's very difficult to quantify them. On one level, during the buy-in period, where the insurance policy that you have as an asset of the scheme, a mismatch between that buy-in policy and the member's legal entitlement is actually not that big a problem on one level, because you still have the scheme, you still have the trust, you still have the sponsor's covenant if the covenant is substantial, and that can allow you to go back, have a conversation with your employer, have a conversation with the insurer, and hopefully secure the additional benefit that you've not identified if it's one that's capable of being insured. When you move to buy out, this becomes a much more serious problem, because essentially at that stage, the aim of buying out is in most cases to wind up the scheme and to draw a line under the liabilities associated with the benefits. And in that scenario, you could find that there's a bit of a lacuna in terms of what the member would do in that scenario. So what we're finding now is that there's an increasing focus quite early on in the kind of buy-in, buy-out journey to begin to think quite carefully about the scheme's history, to think about the steps and due diligence that you can do to kind of flush out the risks, or to take a view that you're going to try and secure the benefits and put in place additional layers of protection that might mitigate this risk in a different way.
Okay, right. So what are the schemes doing about this?
The first step is, as I've said, to mitigate by getting the benefit right. So, you know, if data is usually where people start, and there are steps that can be taken in the form of a data correction exercise to write out to members and potentially try and verify that the data you've got is the right data. You can also do a more fulsome data audit where you actually ask a company to come in and check that the calculations that you've done have been done correctly. On the legal side, which is what I'm interested in, there is a range of options for the amount of work that you can do in preparing a benefit specification, which essentially comes back to how far back you go and what you look at when you do it. And obviously, the more you look, the more confidence you can have that the benefit specification that you're using is as correct as it can be. All of this comes around to the different types of security that you can look for. Security is the wrong word. Insurance that you can purchase or indemnity that you can obtain. So the first line of defense here, really, for many schemes might just be the company indemnity. So again, if you have a relatively financially stable, substantial company that is sponsoring the scheme, it's quite a natural conversation to have at the point of buy in, buy out. Pardon me, particularly where you may be looking for additional funding to secure the premium associated with buy in, buy out policy. It's a very natural conversation to say, well, look, as part of this process, we, the trustees of the scheme, are going to want a very full indemnity from you, the company, to meet any claims that arrive after we've bought out. And that protects the trustee, but it also means that the members, if they discover that they haven't got the right benefit, do have somebody against whom they could bring a claim and hopefully get things sorted out in their favour. The other option, and it's one of the ones we're particularly focusing on today, is residual risks cover. Now, residual risks cover is like an additional head of cover if you think about your kind of car insurance or your holiday insurance. There's usually a schedule where you put in your optional extras. Residual risk cover is a little bit like that, where you say to the insurer, you're securing the benefit specification and the data that we've given you, but we want you also to take on board one or other of the risks that we've identified in relation to the scheme. So that's things like missing beneficiaries, data error, benefit specification error, changes in legislation, all of the sorts of things that we know could mean that the benefit's not 100% correct. Now, obviously, there's a cost associated with that. It's typically between 1% and 2% of premium, depending on the cover that you're getting. And it's also an area that's evolving, and we'll see as the conversation proceeds, I think, how there are some potential downsides with this. The other product just to be aware of is that there are sort of third-party general insurers who are beginning to show some signs of evolution, pensions liability resolutions that will do something a bit like a residual risk cover, but from a different insurance background. So there are a suite of options, and in fact, in practice, you're typically looking at more than one of these. You're layering on the indemnity, possibly with some form of directors and officers runoff cover, which is another type of insurance that I've not already mentioned, and perhaps some elements of residual risk cover as well.
And how do you sort of begin to choose?
It's an extremely difficult decision because, as I've said already, you don't know what the risks are until you start looking for them. Residual risks cover, the cover from an insurer who's doing the buy and buyout policy, is an increasingly popular option, but it has some quite important limitations. Typically associated only with sort of the relatively large schemes. You're looking at a few hundred million worth of liabilities before you can even think about it. It's not something that all of the insurers are offering at the moment, though I think more and more of them are. And from my perspective, the big downside of residual risk cover from an insurer is the due diligence that's associated with it. So if I'm an insurer and I'm taking on additional heads of residual risk cover, and so I mean if I've taken on your benefit specification of data, your member liabilities as you understand them, and I'm asked to insure something different, I'm not going to take on that risk unless I've done very, very thorough due diligence into your scheme. And that's in the data, but it's also on the scheme's documentary history. So what you will find is that process is one that should really not be undertaken lightly for quite a simple reason. If you as a trustee identify any risks that are associated with the way that your scheme's documentary history has been formed over time, and again, we're looking at decades of records here. If you discover a problem, the response of the insurer is not going to be to say, oh, that's great, we'll take that risk on. The response is going to be, we will carve that risk out of the scope of the cover that we're offering, or we will price the additional premium for this cover on the worst case scenario basis. So, let's imagine that there was a cohort of members that were claiming far-fetched uncapped uncapped RPI increases on a tranche of their pension or benefits. The insurer would I think, in most cases, seek to insure that on the basis of uncapped RPI increases, an extremely expensive benefit to secure, even if it's arguable that cover is actually probably not properly valid. So what you end up with is that you have gone through a very, very lengthy, very expensive due diligence exercise, and we're talking potentially hundreds of thousands of pounds for a larger, more complicated scheme. And the output of that is cover where the risks that are most obvious, the risks that have been identified, are as likely as not to be carved out by the insurer. Now, there's some strategic things you can do to have a better negotiation on this, but that should probably be the prudent starting position when you go into an exercise. And the kicker for all of this is that if you are a trustee and somebody says, well, look, we've discovered something really nasty, a gremlin lurking in the back of your scheme, perhaps there was a problem with an early deed execution, or there was a course of members' disputes that had been improperly handled, which could result in very significant increases to the liability. You're under a fiduciary obligation to investigate. You can't just say, oh, well, we've got this wrong. We're going to continue administering the scheme on the current basis and just ignore it. You have an obligation to get the member right. So not only will you not have cover from your insurer, you may have the beginnings of a long rectification exercise that could significantly hold up your progress to buy in or buy out and possibly imperil the pricing that you want to achieve or the affordability given the work that you've got to do. So this is something not to undertake lightly, particularly if you're in a hurry.
So even if you get the residual risk cover, it won't be comprehensive?
No, residual risks cover from an insurer is never comprehensive. It's better to think of it in terms of elements of residual risk cover. Now, that's partly because structurally there will be exclusions just based on the way that your scheme has been constituted. You have, for example, past transfers out, the costs associated with expert evidence on or legal advice for the trustees is just structurally not part of it. There'll be standard exclusions, but then importantly, there will also be the exclusions that arise from a due diligence exercise. So one final thing to mention about the due diligence associated with residual risks is that it's very tempting to assume that because you identify issues that there necessarily is a claim or a problem underneath that. That's actually not always the case. What you will find over time is that it's very easy for a motivated set of lawyers who have been asked to find trouble. And that sometimes means that there is a problem, but it might just as well mean that there is no problem, but we can't prove that the scheme has been properly administered. So if, for example, I find that a deed that has been executed in 1932 was not properly signed by all parties, that just means that I haven't found the right document. It doesn't mean it doesn't exist. Now, if the scheme has been administered successfully for 70 odd years, or longer in that example's case, without member complaint, it's pretty good assumption that the scheme is correctly administered. But that doesn't mean that I, as a lawyer, will be satisfied that everything has been done as it should be. So what we sometimes find with these due diligence exercises is that we spend a lot of time and effort identifying issues and problems, which, as I said, would lead to exclusions in the cover, but that doesn't necessarily mean that the scheme has been improperly administered. So this is not necessarily in the member's interests. All it really does is raises questions, creates exclusions from cover, and causes delay and expense to everybody.
Right, okay. So this suggests the company will need to be involved.
The company is absolutely key to all of this, and that's because in a lot of cases, the company will be the one who is asked to provide that indemnity, that final line of defense. So if you imagine a case where we've put in place some residual risk cover with the insurer, we've done all we can to try and make sure that we've got the data right, we've put in place some form of runoff cover, some sort of insurance with a third party for the trustees' benefit. Sitting behind all of that, if I'm advising the trustees, I want a company indemnity so that if all of these other layers fail to provide protection, the ultimate recourse is to the company. And that means they have a really very acute interest in what the intervening layers of cover are, what the nature of the pensions risks are or are not, and really how much work and effort they want to put into those phases, if particularly they're the ones pushing for buyout, as they often are. So education is very important here, and companies may or may not be quite engaged with the pension scheme. They may have a very good understanding, but it's quite often the case that this is the first and the only risk transfer transaction that the company and indeed the trustee have been involved in. So there shouldn't be an assumption from an advisor like me that people have start the process with a very high level of understanding. Now, as said, by far the simplest option in some cases may simply be to say, actually, we don't even want to go down the route of residual risk cover with the insurer. We're comfortable that the scheme is pretty sound. We're comfortable that if risks do arise in the future, we in the company are well placed to solve that. And that means actually you cut out a lot of the trouble that might otherwise be involved in this process.
Is there anything else you'd like to add? I think that was the last question.
Yeah, well, sorry, that's come around a bit suddenly. No, I think we've covered off everything we need to there. Sorry, that's gone on a bit longer than I intended.
Okay, Ralph. Well, thank you very much for coming onto the PMI podcast, and it was really interesting speaking with you today.
Very welcome.
All right. Goodbye.